Good morning. I hope you all remember what we discussed in our previous class. We saw what is a financial system. What is a financial system? It is a network of financial markets, financial assets, financial intermediaries, and financial services which facilitate money transfer. So, anything that facilitates circulation of funds within the economy is termed as a financial system. A strong financial system leads to economic development. Now, there are four main components of a financial system. These are financial markets, financial assets, which are also known as financial instruments, financial intermediaries, which are also known as financial institutions, and financial services. In today's class, we'll be discussing about financial markets, the first component of financial system. So let's see what is a financial market. Any place where financial transactions takes place is known as a financial market. Now, there need not be a physical place where you have to go to transact in financial assets. The financial market could also be carried out online. So it could be a virtual market or a physical market. Both these will be considered as a financial market. Now, it is a place where financial assets are created and exchanged. It can also be defined as centers or arrangements that facilitate buying and selling of financial assets, claims, and services. So any place where financial transactions takes place or any place where financial assets are bought and sold can be termed as financial markets. Now that's classification of financial markets. Financial markets are mainly classified into organized market and unorganized market. The organized market is again classified into capital market and money market. The capital market is divided into three. The industrial securities market, which consists of primary market and secondary market. The government securities market, which are also known as gilted securities market. The long-term loans market, which consists of term loan market, market for mortgages, market for financial guarantees. The money market is divided into four: the call money market, commercial bills market, treasury bill market, and short-term loan market. We look into the classification in detail. So I said the financial markets are classified into organized market and unorganized market. In the diagram, you can see that organized market is again classified into different types. So we'll first explain what is the unorganized market and then see what is an organized market. So what are unorganized market? Unorganized markets are not controlled by any regulatory authority. It is not under the control of the Reserve Bank of India or the Security Exchange Board of India or any other regulatory authority. It is free from control and supervision, and the main participants of the unorganized market is money lenders, indigenous bankers, chit funds, and private finance companies. So who are money lenders? Money lenders are people with surplus funds. They have surplus funds in their hand, so they are willing to lend it to people for an interest and make some extra earning through that means. So money lenders lend their own funds to outsiders and they will charge an interest for the period for which they lent the money. Second category is indigenous bankers. They are a different category from money lenders. While money lenders just lend out the money that they have in the surplus money that they have, indigenous bankers, they also accept deposits. They will accept deposits with the intention of lending. So these people are known as indigenous bankers. They do not just restrict their activities to lending their own funds. They also accept deposits from outsiders and lend it to others. So for the funds that they accept, they will be paying an interest, and for the fund that they lend, they will be charging an interest rate. So there are money lenders, there are indigenous bankers, there are chit funds. I'm sure you are all familiar with chit funds. Chitti എന്നൊക്കെ കേട്ടിട്ടുണ്ടായിരിക്കും. Chit funds means a group of people will come together. They will invest a fixed amount for a fixed period of time at regular intervals, and the money that they collect through this way, they can take when there is an emergency. Chit funds actually came into existence long time back when there were no banks. Banking system ഇല്ലാതിരുന്ന കാലത്ത് വന്നതാണ് chit funds. So during that time, what people used to do is they used to collect funds and lend it to those who were in need of it, like those who are building a house or those who are having a marriage function, the expenses regarding that. If they needed funds immediately, the money that they collected from people will be given to the person with an emergency. So for example, if there are 10 people and 10 people will be contributing 10,000 each, and then for if 10 people are contributing 10,000 each, it will lead to 1 lakh rupees. So for a month, if anyone is having an emergency, one of these 10 people can take this 1 lakh rupees from the chit fund. They can use that money. Second month again, there are again 9 people left in the group. The 10th person will again be contributing 10,000 rupees, and each of these person can claim the fund when there is an emergency. So chit funds are created by a group of people, and the main advantage is that if you're approaching a bank, they will ask you for some sort of a security before lending out money, or if you do not have securities, or if you're sure you cannot convince a bank to raise funds, then chit fund is a good option. So there are money lenders who lend out surplus funds. There are indigenous bankers who accept deposits and lend money. There are chit funds where a group of people come together, pool together their funds, and then take the money from the chit fund when there's an emergency. And there are private finance companies. They are all free from regulations, so they form part of the unorganized market. Second one is organized market. For the organized market, like the name denotes, there are standardized rules and regulations. These are under the strict supervision and control of the RBI, the Securities Exchange Board of India, and other regulatory bodies. So they are always regulated to ensure that there is free and transparent trade going on, that there is no manipulation or exploitation of the people who are engaging in buying and selling activities. So these are the organized market. The organized market is again classified into two, the capital market and the money market. So what is the capital market? Capital market is a market for long-term securities. Those securities which have got a maturity period of more than 1 year are dealt with in the capital market. If you are interested in purchasing a security and you will be planning to sell it only after a period of 1 year, maybe after 3 years or 5 years or 10 years or 15 years, then that security is uh, described as coming under the capital market, because you're holding that security for a long period of time. Then that security will come under the capital market. It is a market for long-term securities, those securities with a maturity period of above 1 year. Then comes the money market. What is the money market? It's the opposite of the capital market. Money market is the market for short-term securities. These securities have a maturity period of 12 months or 1 year. That is, if you are purchasing a security and intending to sell it before the end of the year, then it will be considered as coming under the money market. So the market for dealing with financial assets and securities which have a maturity period of up to 1 year is known as money market. So don't forget, financial market is classified into the unorganized market and organized market. Unorganized market consists of or we can say the main players of the unorganized market are indigenous bankers, money lenders, chit funds, private finance companies. Then comes the organized market. It is classified into capital market and money market. Capital market is the market for long-term securities, and money market is the market for short-term securities. Now we saw that the capital market is again classified into three. The first one is industrial securities market. So what are industrial securities market? These are the securities which are issued by companies or firms, and it could be equity shares, preference shares, debentures, bonds. All these are termed as industrial securities. So the market for these securities are known as industrial securities market. The market for securities which are being issued in the industry is known as industrial securities market. Now, the industrial securities market is classified into the primary market and the secondary market. The primary market has got a different name. It is also known as the new issue market, NIM, N-I-M. I have given it in bracket, new issue market. Now, why is it called a new issue market or a primary market? Suppose you are a company. You're starting your company and you need to raise funds. You decided to raise funds by issuing shares in the share market. If you're offering your securities for the first time, then those securities are offered in the primary market. That is, if you're offering your securities or if you're introducing your securities to the buyers for the first time, then it is introduced in the primary market. It is the market for first-hand securities. Now, it is not necessary that only new companies can offer shares in the primary market. Sometimes existing companies will choose to introduce a new type of share, something which they have not introduced earlier. For example, when you started your company, you were offering only equity shares. That time you gave the shares in the primary market, you raised funds. Now you are planning to offer preference shares to the people. You're planning, you want some funds for expansion or you are going for modernization, you need funds. So you decide to raise that funds by offering preference shares. Then if you're turning to a new class of securities, earlier you were issuing equity shares, now you are issuing preference shares. So when you're offering this new category of securities, you are an existing company offering a new category of securities, you'll be offering it in the primary market, also known as a new issue market. You might get a question in the section A asking what is NIM, new issue market, don't forget. Now, people will subscribe to the shares, they'll purchase the shares. Once they buy the shares, we know there are different types of emergencies. People might want to raise funds and they might be interested in selling the securities that they bought in the primary market. Now, where will we go to if we want to sell the securities we bought from the primary market? There comes the role of the secondary market. You can sell your securities in the secondary market. Secondary market is a market for second-hand securities. That is, the securities which you bought in the primary market can be sold in the secondary market. The secondary market is also known as stock exchange. So if you already invested in some shares, but right now you need funds, you want to sell those shares, you will simply sell the shares in the secondary market. So it is the market for second-hand securities, the place where you sell the securities which you already bought, or the place where you buy second-hand securities. If you're approaching the stock exchange, you can buy shares from people who have already bought it. You're not buying it from the company, but you're buying it from people who have already bought the securities from the company. That is known as a secondary market. I hope I made that point clear. Now, the second category that comes under capital market is government securities market. Government securities market has got a different meaning. It is also known as gilt-edged securities. I've given it in brackets. Just go through it. Gilt-edged securities. Government securities are the securities which are issued by the government. That is, the RBI issues the government securities on the request of the government. These securities have zero risk. It does not carry any sort of a risk, or we can say it is risk-free securities. Why is it called risk-free securities? Because government security has an assurance from the government or a promise from the Reserve Bank of India that the person who purchased these securities will get back the amount deposited. It is a promise from the government. So there is no risk of losing your capital money or losing the interest rate or anything. You'll get back the money which you invested in the securities. That is why it is considered as risk-free securities. So the government securities, for an example of government securities is treasury bills, also known as T-bills. So the government securities are also coming under capital market. Third one is long-term loan market. Long-term loan market consists of the term loan market, market for mortgages, and market for financial guarantees. What is the term loan market? It is the market for loans which is issued for a specified period of time. That is, if you are giving out the loan for a period of 5 years or 10 years or 15 years, then it comes under the term loan market. Now, what are market for mortgages? The term mortgage deals with giving loans for immovable property. If you are keeping your house as a security and taking loan, it can be considered as mortgage. If you're keeping your land as security and taking loan, it will also come under mortgages. So it is a market for mortgages is the market for immovable property. If the loan that you take for immovable property. Third one is market for financial guarantees. Sometimes financial institutions are willing to stand as a guarantee for the loan that you take or the money that you owe. Now, the market that deals with such sort of financial guarantees are known as market for financial guarantees. So the industrial securities market, the government securities market, and long-term loans market comes under the capital market, which deals with securities which have got a maturity period of more than 1 year. Now moving on to what are money market. I said money market is a market for short-term securities. The maturity period is for 12 months or less than 12 months. So this money market is classified mainly into four: the call money market, commercial bill market, treasury bill market, and short-term loan market. So what is the call money market? It is a market for extremely short period loan. The money that you take as a loan is for a period of 1 to 14 days. You could be you could be borrowing money for 1 day or up to 14 days for 2 weeks. This is dealt with in the call money market. Now, who will take or who will borrow money for just 1 day? A good example is commercial banks. Sometimes commercial banks need urgent funds and maybe their source of income is blocked due to some reason. They need funds, then they can borrow from the other banks. It could be borrowed for a period of 1 day or 2 days or 5 days or 14 days. So they will depend upon the call money market. Why is it called call money? Because it is to be returned when asked for. When the person calls the person who borrowed, asking him to return the money, then he'll have to return it. That is why it's called call money market. If you're taking the money for a period of 1 day, if you are borrowing only for a period of 1 day, it is termed as overnight money. If you are borrowing for a period of 2 to 14 days, it is called notice money. That is the moment that you get the notice from the lender saying that he needs the money back, you will have to return that cash. That is why it's called notice money. If you are borrowing for 1 day, it is called overnight money. So call money market deals with extremely short period loans. Second one is commercial bill market. What is a commercial bill? The bill of exchanges. I'm sure you're familiar with the term bill of exchanges. That is, if you are selling your goods for credit, that is, you're not selling it for cash, you're saying you'll give the goods now, the buyer can give the funds at a later date. Then the buyer will be giving a bill of exchange as a assurance that he'll make payment at a future date. Now you sold goods today and the buyer said he will make the payment after 2 weeks, and he gave a bill of exchange stating that the money will be due after 2 weeks. But then you met with an emergency. You need funds immediately, right now. So what you can do is you could just go to a bank, discount the bill of exchange and get the cash immediately. That is, if the bill is for 50,000, that is, you sold the goods for 50,000, 50,000 rupees will be given to you after 2 weeks, but you need it right now. What you will do is you will take that bill of exchange worth rupees 50,000 to the bank. You will give it to the bank, ask them to give the money immediately and collect their fund after 2 weeks. So the bank will discount a certain amount as their charge. They will discount, for example, let's suppose they will be discounting 5,000. Then they will give you 45,000 immediate cash and they will collect the entire amount after 2 weeks from the buyer. So the market for bill of exchange is known as commercial bill market, the place where you can deal with bill of exchanges. Third one is treasury bill market. I already mentioned it when we discussed about government securities market. So we know it is a promissory note or a finance bill which is issued by the government. The treasury bill is a promissory note which is issued by the government stating that the amount borrowed from the person will be returned after a specified period of time without any fail. So it is a risk-free security and the market which deals with treasury bills is known as treasury bill market. There are different types of treasury bills. I would like you to find out what are the different types of treasury bills and give me a write-up on it in our next class. The fourth category is short-term loan market. What is short-term loan market? The market for short-term loans. That is, the loan is taken for a period of 1 year or 2 years. Then it is a very short-term loan. And the market which deals with this is known as short-term loan market. Now, why do companies need short-term loans? It could be to meet their working capital requirements. What are working capital requirements? The funds that you need for the day-to-day running of your business is termed as working capital. So if you need funds for the day-to-day running of your business, but right now you're facing a shortage of funds, then you can take a loan for a short period of time, and this loan can be taken from the short-term loan market. So explain what is capital market and what is money market. With that, we'll end the classification of financial markets. So the financial system consists of 4 components. The first component is financial market. The financial market is the market for financial transactions. The place where financial assets are created and exchanged is termed as financial market. It could be a physical market or an online market. The financial markets are classified into organized market and unorganized market. The unorganized market is free from regulations. It is not controlled by any regulatory authority. It is not under the guidance or supervision of the RBI or the SEBI. And the main players of the unorganized market is the indigenous bankers, money lenders, chit funds, etc. Second one is organized market. It is under the strict supervision and control of regulatory authorities like RBI and SEBI. It is there to ensure that there is free and transparent trade, that everyone is free from exploitation. So the organized market is again classified into capital market and money market. The capital market is the market for long-term securities. The maturity period of the securities which are dealt with in the capital market extends for more than 1 year. Money market is the market for short-term securities, or it is a market where securities with less than 1 year's maturity is dealt with. Now, capital market is again classified into industrial securities market, government securities market, and long-term loans market. Industrial securities market are the securities which are being issued by the firms or companies. Examples are equity shares, preference shares, debentures, bonds, etc. These securities, if they are issued for the first time, then they are introduced in the primary market. Now, the securities bought in the primary market are sold in the secondary market. So we can say that the secondary market is the market for second-hand securities. Now, coming to government securities, these are securities which are issued by the government. It is completely risk-free, and it is in the form of a promissory note which is issued to the public, promising that the money that is borrowed by the government will be returned after a certain period of time with interest. It is also known as gilt-edged securities market. Don't forget that the primary market is also known as new issue market, and the secondary market is also known as stock exchange. Now, the third category under capital market is long-term loans market. It is again classified into the term loan market, market for mortgages, and market for financial guarantee. The term loan market is the market for loans for a period of 3 years, 5 years, 15 years. That is the loans for a specified period of time. And that if the period is for a long period of time, it comes under long-term loans market. Market for mortgages deals with the loans taken on immovable property like house, land, etc. Market for financial guarantee is the market where institutions stand guarantee for the loan taken by a borrower or a businessman. Now, what is a money market? The first one is call money market. I said it is a market for very short period of uh, borrowing. That is, if you are taking the money for 1 day, it is called overnight money. If the money is borrowed for 14 days, it is called notice money. The money that you take in call money is to be returned on receiving notice. That is why it got its name. Now, call money market is mainly used by the main player of the call money market is commercial banks. Second one is commercial bill market, where the bill of exchanges are transferred. That is, when you're making a credit sales, the buyer will give you a bill of exchange. If you're in need of immediate cash, you can go give this bill of exchange and get cash immediately. This is the market for dealing in bill of exchanges is known as commercial bill market. Third one is treasury bill market. Treasury bills are also known as T-bills. These are government promissory notes for raising funds for government purposes, and these will be returned after a specified period of time. The next last one is short-term loan market, where the loan money is lent for a very short period of time, maybe for a period of 1 year or 2 years, and that is dealt with in the short-term loan market. So this is the first component of the financial system. We'll discuss about the second component in the next class, and that is financial assets. I hope everything is clear. If you have any doubts, you can just drop it in the chat box. So thank you.